VICI continues to drop in this current market. It is down 9% year to date, and it is one that I have been adding over the last few weeks. And now in today's episode, we will take a look at VICI Properties with their updated earnings, running through their historical performance. We're going to look at their income statement, top line revenue, as well as bottom line net income growth with their new reported quarterly earnings. We're going to look at the balance sheet, their total cash versus their total debt, to see how safe and healthy this company is for the long term. We'll also view them in their industry, in the real estate, other specialized REITs, comparing them to other companies on the total return as well as the last 5 years with those dividends reinvested. And we'll also analyze whether or not institutions are liking this company and run it through our dividend safety, look at that as well as financial metrics to understand how well this REIT is positioned for the future. And as always, we will run them through our valuation model, getting to our intrinsic value and finding out our acceptable buy price given our investor margin of safety. Now, this is one I have talked about on the channel. It is one I have been adding to my portfolio. Now, it's down 9% year to date. We can see it trading towards the mid to lower end of the 52-week range, offering a yield of just under 6%. Now, investors who have been holding this company over the last 5 years, given that it was only founded recently, can see it is up 30%. We did see it drop due to that COVID from around 27 all the way down to 11, but it has picked up nicely, but it is still trading below its all-time high that we did see around last year, around $35, $36. Now, taking a look at the company, their income statement, what we like to see, 5 to 10% year-on-year growth for REITs, 900 million reported in December 2018, 2.7 billion in December 2022. And on top of that, what's nice to see, trailing 12 months. Now, they are due to report their December 23 earnings over the next few months, but it is looking like we're going to see a very nice increase on December 23 as well. And when we take a look at a granular level, we do see fairly flat from 18 to 19 before some nice increases year on year. So that's very positive to see. And I do expect to see some very nice December 2023 numbers. And we will surely also analyze the last 10 years increases percentage-wise too, in fact 5 years. So net income bottom line, 524 million reported in December 2018, 1.1 billion in December 2022. So we do see some inconsistencies. It does in fact have fairly flat net income from 2018 to 19 before increasing very nicely over the next few years. And that trailing 12 months for also bottom line is showing a nice increase. So very positive to see for VICI, nice growth over the last 5 years. And I do expect December 2023's report to also show some very solid growth. Now, quick look at the balance sheet, their health check, total cash versus total debt. 578 million reported on the balance sheet in 2018, 511 in their latest quarterly earnings. So we can see their cash position has dropped roughly around 10% over the last 5 years. But when we compare that numerically and directionally to their total debt, this has gone up quite significantly from around 4 billion to 16.7 billion. So more than 4 times increase on their total debt, while seeing their cash drop by around 10%. Now, this is fairly typical for REITs. It's a way that they do expand. They take on more debt. And we will take a look shortly at the net debt to EBITDA metrics for those dividend safety scores. Now, in terms of comparison of other companies such as Iron Mountain, Gaming and Leisure Properties in the other specialized REIT industry, now year to date we can see VICI with those dividends reinvested down 6%, roughly in the middle of their peers. And when we expand that to the last 5 years, what we see, again, remember we are looking at the total return, they are up around 98%, which is very positive to see. They are the second best performing in the industry, just behind Iron Mountain, up 161. But as always, do bear in mind, past performance is never indicative of the future, and it's just one piece of analysis we do. Institutional ownership sitting at 97%, around 2 billion sales over the last 12 months by these institutions, and we see roughly double that in terms of buys over the same period. So institutions are liking VICI Properties more than they are disliking it. In fact, we see over the last few quarters, in fact, every single year with green depicting inflows, red depicting outflows, institutions are buying more than they are selling. Now, as always, we don't copy what they do. We always have to do our own due diligence, so do bear that in mind. And before we take a look at that dividend safety and financial metrics, we can look at last quarter's earnings. So in terms of earnings per share, they had a rough surprise of 0.54%, and they had a rough 0.22 positive surprise on the top line. So they did beat on both earnings per share and revenue, although marginally on both. Now, what I like to do is do a very quick Q3 2023 versus Q3 22. So Q3 23 versus Q3 2022. A bit of a mouthful there. Year-on-year increase, so we see their revenue up 17%, bottom line net income up 68%, and diluted earnings per share also up, as well as their net profit margin and operating income. So very positive to see. Not only last quarter did they beat both Wall Street estimates on earnings per share and revenue, but they also beat significantly on every single metric on a Q3 23 versus Q3 22 basis. So nice to see. Now, dividend safety score coming in at 50, so borderline safe. We do see a market cap of 30 billion, so it is a large cap company. Now, when we take a look at their latest increase, this was 6.4% of September this year. So it is nice to see above that 4% inflation that I always advocate on the channel, especially when your yield is nearly 6%. And they have been increasing their dividends for the last 4 years. Now, in terms of dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Bear in mind, we're not looking at any of these models in isolation, and we will draw our conclusions towards the end of the episode. Forward P to FFO, again undervaluation signal 13 below 14.8. And when we compare the sector P to FO, it is roughly in line at 12.9 versus VICI's 13. Now, when we take a look at the payout, and remember, for REITs, we tend to ignore the free cash flow as they are more volatile, so we stick with the adjusted FFO, funds from operations payout. So below 75% is what we target for hotel REITs, and what we can see over the last 5 years, VICI have roughly been in line around that 75%, and they are expected for 2023 to be again in line with that maximum 75% we look for. So far that dividend does seem to be nice and safe. Now, adjusted funds from operation per share, 37 cents in 2017, 193 in 2022. So it's nice to see the growth. Some years we do see larger growth than others. And in better news, 2023 is expected to continue that trend of increases consistently. So very positive to see consistency with this company. Now, sales growth, if you remember, 5 to 10% is what we aim for REITs. And over the last 8 years, we can see it has effectively been significantly better, nearly double digits every single year. So numerically speaking, what that means, 200 million of sales in 2017, 2.66 billion in 2022. And we can see the trading 12 months showing us a sign that it does look to be a very strong year on terms of the top line for VICI. Now, one thing to bear in mind with REITs, as we always mention, for those that are new, REITs do typically do the opposite of what we like to see. So for normal companies, we do like to see when they do share buybacks, returning excess cash to our pockets. With VICI Properties, as they are a REIT, it is typical that they issue equity, as we see here, to fund property acquisitions. The reason for this is because they retain a little of that internally generated cash flow after paying dividends. As we saw, they do have a fairly high payout ratio. So this is very typical, although you will note with some REITs, they do issue shares at a faster rate than others, and some others do issue at a lower rate. So when we do take a move onto the ROIC for REITs, typically 3 to 5%, other companies 10% plus, so fairly positive over the last 5 years, around that 5% plus target. So that is very nice to see in terms of management and their ability to effectively allocate their capital. And it's nice to see the trailing 12 months around 8%. So I would expect 2023 to be higher than 2022. Now, operating margin, very nice to see, around 60 to 90%. It does fluctuate, but it is still a very high percentage, which is very positive to see for the operating margin, as we would expect with a high operating margin, in theory, a higher bottom line net income, which means nice dividends and dividend increases to investors. Now, net debt to EBITDA, one reason for why we see that borderline safety score for VICI Properties' dividend is because we are looking at the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, which directly correlates to that score. So what we're looking for hotel REITs is below 3.5, which signals the number of years it would take the company to pay off all of their debt net of cash on hand. And we see in 2022, it has gone much higher than 2021 at 6.46. Now, it is expected to come down in 2023, but it is still higher than the 3.5 that we do target. So do bear that in mind. Whilst I do think that dividend is safe, we did see a fairly nice increase in 2023. We just would like to see that net debt to EBITDA, and in fact, their total debt come under slight control. Now jumping on into the valuation model, and as always, if you are enjoying the content, value is being provided, do smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or wish list, do click on that pinned comment below and grab a copy. Now, regular viewers know for REITs we don't look at Graham's valuation. We do ignore that. It's not appropriate. But for those that are new to the channel, we effectively put in the stock ticker symbol, VICI, earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds, bearing in mind the higher that yield, the lower the intrinsic value. Now, let's take a look at the first model we're using, which is the REITs multiple valuation model. Companies we analyse on the 5-year return: Iron Mountain, Gaming and Leisure, Lamar Advertising, stock price, P to AFFO multiple, average P to AFFO, the P to AFFO of VICI, and we get a stock price based on this model of $29 to $30. So we can see that signals around 5 to 10% upside to the current trading price, but within that 52-week range, showing some small signs of undervaluation based on this model. Do bear in mind though that we're not looking at any of these models in isolation and drawing our conclusions towards the end. So we then have the dividend discount model, the DDM model, where we have our yearly dividends. Some nice growth over the period, now average 9%. And as always, there will be investors who will look at this and say they believe it should be higher, and some who are more conservative and say it should be lower. So if you do grab a copy of the model, you can play around with these percentages, but I've gone for at least 4%, so in keeping in line with inflation at a bare minimum, given their track record, that does seem to be reasonable. So this gives a DDM price of $44. Now that is far above the 52-week high, showing signs of severe undervaluation in the market for VICI Properties. Now when we move on to the third model, the DCF model, where we have the free cash flow after the last few years, we have the growth rate per analyst estimates and that discount rate to get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $38. Now that is slightly higher than the 52-week high, but again it's signalling undervaluation of VICI Properties in the current market. As always, the intrinsic value is just the average of the models we've run through, and if you are enjoying the content, value is being provided. Do smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. Now the intrinsic value coming to $37 with a current price at $28. Now there are some reasons why we do see this share price suppressed. You could argue the macroeconomic conditions, high interest rates, and therefore when we do start to see the Fed cut those interest rates in 2024 or beyond, then we would start to see this current price head more towards the intrinsic value. So margin of safety, we do start off with 10% as always if we believe it has a wide moat, strong financial metrics and good forward-looking data. So if you believe that for VICI, you would be looking at around $33. Those looking at 20%, it would be around $29 in fact. And for those looking at 25%, it would be around $27.85, which as we can see is still within the 52-week range. Therefore, this signals you are currently getting between a 20 to 25% margin of safety on VICI Properties. Now, what are Wall Street saying? Well, they believe the share price to hit around $36 over the next 12 months. So they do also see some very nice upside to this company over this period. Now, as always, you have to do your own due diligence. Never copy what Wall Street say and always look at the metrics, look at the analysis and decide whether or not you believe this to be fair valued, undervalued or even overvalued. Personally, this is one that I have been buying. It is one that I have been explaining on the channel time and time again why I like it. We have run through on other videos the different avenues that VICI Properties are looking into and their expansion, and just a lot of metrics when we've analysed their investor presentation. So if you do want to have a look at that, do look at other videos that we've done on VICI where we've run through their investor presentation, looking at their tenants and looking at a lot of metrics that we do like within this company. Now, personally, as I mentioned, it is one that I have been adding and will continue to add, but do let me know your thoughts in the comments below. Is VICI one you've added to before, one you're looking to sell, or even if you don't like this company, do let me know your thoughts. But personally, this is one that I do like. As always, if you do enjoy the content, value is being provided. If you hit that like button, it helps the channel grow, pushes the content out to more viewers and investors. And if you do want to have these videos dropped to your doorstep on a daily basis, do click on that bell button above. Now, finally, if you want to grab a copy of the valuation model to get to the intrinsic value and margin of safety and acceptable buy price of companies in your own portfolio or wish list, do click on that pinned comment below. And finally, we'd love to see you, chat with you in the Discord, so do click on that Patreon link and join us. As always, have a great day, catch you on the next episode and take care.